All right, so first off on the 1040 side, so let's take a look just at the differences in our personal deductions. So I've got standard deduction versus itemized deductions, but let's look at this in 2018. Your standard deductions are now up quite a bit, nearly double. For a single filer, you're at $12,000. For a head of household, you're up to $18,000, which is great. And then for those who are married, there's the $24,000. Again, no marriage penalty for there. Really interesting comes in on the itemized deductions, because what we give, we have to take away. On the itemized deductions, there's going to be no P's phase outs. Those were where Senator Pease, when your exemptions and other items became so great, you got a little bit of a haircut as your income went up. So those P's phase outs are now gone. State taxes are being limited, so they're being capped at $10,000. Got to be careful of those going forward, especially if you're have multiple properties or maybe you're in a high tax state. Mortgage interest had some changes there in regards to large jumbo loans, or if you're going to go refinancing, for example, line of credits, home equity mortgages going forward. Be really careful of those. Some of those may not be deductible going forward. You want to be careful if you ever decide to refinance, because if you refinance, you could mess up the grandfathering provision there as well. So talk to your tax advisor before you go out and mess with the home mortgages. Charitable deductions, we're now at 60% of AGI, so that's a little bit of a benefit for us. Casualty losses are being redefined. To simplify it, it's basically, it needs to be a presidentially declared disaster at this point in order for it to qualify. And the biggie, no more 2% itemized deductions. A little further in the slide deck, I'll talk about what those are. But think about it, that's a really big deal. If you've got a taxpayer or somebody with a lot of unreimbursed business expenses, those are no longer deductible. Fees for legal and tax advice are no longer deductible. All of those 2% have gone away, so we need to start planning around those. Now let's switch over to the exemptions. Back in 2017, you did get a personal exemption. You got about $4,000 for an individual, and you got a $1,000 child credit. We've kind of flipped that all upside down again. Because the standard deductions are now higher, you have a little less need. So again, what they gave you, they had to take away. So Congress has done away with the exemptions. It's now zero. But they did offer you a little bit of a child credit. So if you're 17 and under, again, they did change who qualifies under the child's. So $2,000 for the exemption. They did give you a little extra. So for example, if you had another dependent who was older than 17 but was still in your household, they did give you a little extra bump so that you don't totally lose out on those. And that's a $5,000 dependent credit. The income phase outs are at a much higher rate as well, nearly double. So if you're looking at single or head of household, you begin to phase out between $200,000 and $240,000. And if you're married, you're in the $400 to $440 range. So let's kind of take a look at some of the other issues. And again, like I mentioned, the itemized deductions are going away. This is a big deal. Look at the long list. You've got moving and job hunting expenses. Those are going away. Unreimbursed business, employee expenses, investment advisory fees, the home office deduction. That's a very big deal, especially if you're a salesman, you're on the road, or maybe your employer isn't reimbursing you for a lot of those business expenses. Things like union dues, again, professional licensing, hobby losses, gambling losses. All of these things are no longer deductible because they've done away with that 2% itemized deduction. A couple of changes regarding the NOLs. This is a big deal as well. You're now limited to NOLs up to the first $250,000. That's all you can deduct over on the personal side. NOLs are no longer being carried back. Again, the exception on the screen there is the farming NOLs. Those can still be carried back to 2 years. None of the other NOLs are allowed to be carried back, but it used to be you were limited to carrying forward for 20 years. Now you can actually carry those forward indefinitely, with a couple of caveats, of course. Going back to any carry forward you're only allowed to take up 80%. So I've got an NOL in this year. I've used the NOL. I've taken my $250,000 and I'm carrying some forward. I'm only allowed to offset up to 80% of my income in the future. So that's what they mean by the 80% offset. I mentioned the public charities. Deductions are now 60% of the AGI versus the 50. The kiddie tax is another interesting twist here. It used to be that you had a complex calculation to where if you had a qualifying child, 17 or below, I believe, and you made more than $2,100 of unearned investment type income, they would actually make you tax that portion of the income at the parent's rate. So a lot of times you'd have to figure out what's the parent's rate. Maybe I'm not doing the parent's return, maybe you are, maybe the kid's filing somewhere else. So it's really complicated trying to coordinate those two tax rates. They've simplified that a little bit and said, okay, instead of using the parent's highest rate, we're now going to use the trust rate. Yeah, that simplified it, but it also made it more expensive because your trust hit those higher brackets much sooner than you and I as individual taxpayers would. So another little catch you there. Over on the Roth IRA side, everybody has to be careful in 2018 because they're no longer the recharacterizations. Recharacterizations were when you take a traditional, you try to bump it into a Roth and then you try to bounce it back and forth. Can't do the flip-flopping anymore. Another big tip, I think most of the divorce attorneys are on top of this, is the alimony. It's no longer deductible alimony to the payer. In 2018, starting in 2019, no longer going to be taxable to the recipient. And all of these, most of these need to be settled up by the end of the year. That's why all the divorce attorneys are cranking, because after 2018 is when these provisions come into effect. If you happen to have a divorce decree that you go back to court and you have some changes to it, that could mess up the grandfathering provision. So be careful going back, trying to go back to court for something to change the decree. It could nullify the taxability of that. AMT, this could be some good news here. The thresholds have all jumped up, which is great, $191,000 for married filing joint. And if you think about a lot of the preference items that you had that caused you to go into AMT, a lot of those preference items were 2% itemized deductions. If you do away with the 2% itemized deductions, we've done away with a lot of preference items. So that basically means that less and less people will be affected by the AMT. And let's face it, I think that's a good thing. So what's going to happen to my tax bill? Out with the old, in with the new. So it's going to be a total shift of the way we think. It's going to be a little bit different going forward. We just need to continue to work through some of these issues. Most of what we're seeing now is just proposed regulations. The IRS is still trying to process what the form is going to look like, what the final rules are going to be. So there is a little bit of ambiguity here. A couple of takeaways and reminders. Just take a look at those standard deductions, all those rows. They were, again, $6,350. Now they're $12,000 for single. Head of household was $9,350. Now it's up to $18,000. And the married filing joint went from $12,700 to $24,000. Don't forget, personal exemptions are all gone. Child credits did increase from $1,000 to $2,000. Don't forget about your itemized deductions going away, especially the property taxes and 2%. So if you take a look at all of those itemized deductions and you think about the number of people who did file Schedule A itemized deductions versus didn't. So in 2017, we had more than 26% of people nationwide in all income brackets itemized. Fast forward to 2018, it's going to be less than 8% of people will actually get a better benefit by itemizing. Creates a little less work for us, but again, that's a planning opportunity. All right, I appreciate your time.